by having that asset there and knowing it's there and knowing it's the backstop, I can actually stay invested in the market right up until the day I retire without being afraid of a market crash.
Well, hello and welcome to another guest interview here on the Profit with Law podcast. I'm your host, Moshe Amsel, and I'm excited about our conversation today because, as you all know, our focus here at Profit with Law is on helping you not just solve your own profitability problems, become independently wealthy, but actually to help you create generational wealth. From the story of my grandfather, left Nazi Germany when he was 11 years old and ultimately went into business on his own, invested in a apartment building on the west side of Manhattan, and from that apartment building was able to provide all 36 of his grandchildren with the down payment of their first home purchase. I was inspired by what I received from him and how much it helped me, that I am on a mission to help others do the same. So our mission is to empower all people with wealth creation so that this and future generations can lead a better life. And if you are looking to lean into that and figure out how to not only grow your business, but also grow your personal wealth and create a legacy for you, your family, or for something that's really meaningful to you, then you might want to jump on a strategy session with us. And you can get that at profitwithlaw.com/strategy session. And that's absolutely free. Spend 30 minutes with myself or one of our coaches and help us just clarify what your end game is and what's getting in the way so that you know what the next steps are that you need to move forward. My guest today is Tom Wall. Now, Tom spent his career, his life, really wrapping his head around whole life life insurance, and really excited to be jumping into this conversation because people don't really think of life insurance as a retirement vehicle or as a tax strategy or as a wealth saving tool, wealth creation tool. And I want to explore that with him because people typically think of life insurance as a thing that they're going to use to make sure that their loved ones are taken care of. But what if it could be more than that? Or what if you're far enough along in your career and perhaps you haven't done a great job of saving for that next step and you do want to leave something for the next generation? How can we use these vehicles to make that happen? So Tom is a keynote speaker, author, and expert in permanent life insurance-based strategies. His book, Permission to Spend, is an instrumental tool in understanding how to position life insurance as a retirement and wealth creation vehicle. And we will link up in the show notes to this episode a link for that book. You don't need to write it down if you're in the middle of a run. We got you covered. He has been in the financial services business in various capacities for 22 years and now coaches thousands of financial advisors throughout the country. So, Tom, welcome to the show.
Well, thanks for having me. It's really great to be with you.
It's my pleasure. And real quick, just why don't you give our audience the backstory? Just why life insurance? How in the world did you get into this, and why are you passionate about it?
Yes, it's not every little boy's dream to grow up and be a life insurance expert, but here I am. I've been in the financial services business, for 22 years since right out of college, and entered the business basically selling life insurance for one of the major mutual life insurance carriers before, quickly turning into a full-fledged financial advisor with all the investment licenses and financial planning tools, et cetera. But really, spent the majority of my career working at a major mutual home office, basically, as an inside sales rep for their products, talking to advisors about where it fits, the strategies that worked, and where I got fascinated by the business was did this actually make sense, or was it just a good sales pitch for a guaranteed product you probably wouldn't have to apologize for? And through my studies of a couple of master's degrees that I put together in hotels while I was on the road, and toward the end, actually a PhD in retirement income planning, with a dissertation in whole life as a fixed income alternative in retirement. I got very convicted around the fact that this is probably one of the best kept secrets in personal finance for a lot of different reasons. So much so that I've, the last 4 years built a career around actually speaking to advisors about how they can speak to clients about it, where it fits, where it doesn't fit, competing with some alternatives out there that may sound, sexier or more modern, but with that typically comes a lot of risk. So, I come from a place of guarantees, safety. How do we actually put some of those things into a plan so that you can take risks and own businesses? invest in real estate, and do all the things that generation that have created generational wealth. Um, that's kind of where I'm at.
Awesome. I love it. Now you did say a couple of things that kind of, got my wheels spinning. I know that the thing that holds a lot of people back from whole life is just the cost of it, right? So, because you're packaging savings and a life insurance plan into one, it ends up being a lot more expensive. So, say somebody who wants $1 million in coverage, they can get that for 800, $1,000 a year in a term policy. But in a whole life policy, and I have no idea what the amounts are, but my guess is probably $3,000 to $4,000 a month is what that would cost. So there's obviously a massive difference in the cost of that, and I think that most people think of that in terms of a layman's term, like they're a W-2 worker, basic salary, and but as a business owner, there comes this time where you start to unlock this large amount of cash flow that's coming in, from your business, and maybe the dynamics of that change. So tell me, where's the threshold? Like, when is somebody ready to start thinking of life insurance? And we'll get into why they should and what the strategy is. But who are we even talking to when we're discussing these strategies?
It's a great question. I think at a basic level, most people with a good six-figure income that are saving for retirement are going to retire at least, with low single-digit millions, kind of the mass affluent crowd. I think that's really where it's a great fit, and frankly, that's the kind of the target of my book is how those folks can shift risk, meaning they can guarantee a legacy for the next generation or at the very least their spouse. They can build a conservative bucket of money that's not subject to market risk or fluctuations. They can solve for some of the risks in retirement, like potential long-term care needs, and to the extent they can shift those risks away, they can stay more invested in the market closer to retirement versus taking all the risk and upside off the table. Um, and also just use it as an asset to kind of weather the storm. So if the market has, crushed your portfolio for a few years, like we saw a couple times right after 2000 and 2008, you have an asset that you can tap into and leave your money invested or leave your business interests intact. So that's kind of where it fits on the entry level scale. But we find that there's a lot of wealthier folks that gravitate toward it because of the tax advantages. I think a lot of people kind of take a lazy approach to looking at it and saying, you're getting 4 or 5% here, I can get that elsewhere. But it's really not about rate of return. It's the fact that once the money goes into these plans, it leaves the tax system if you do it right. So that becomes increasingly attractive for people that are paying taxes at the highest rates. And I think that should be the focus in a lot of cases.
Now, I mean, let's just put this in context. I mean, if somebody is a business owner, putting money into tax advantage places is very limited, right? Like, even if they're doing a 401k, I think the max amount that an owner could put in is 60, 70,000. We could look at defined benefit plans, but there you need to include probably some, or if not all, of your staff, in that plan. So, for you to be able to put away significantly, you also need to put away significantly for everyone on your team. Um, this is a tool for you to be able to put money away that's going to avoid taxes in the future. Is that accurate?
Yeah, that's exactly right. So you mentioned like the premium that you pay. I don't like to say that it's a higher cost necessarily. It's a higher outlay, but you get it all back one way or another. So the difference is really, term insurance is temporary life insurance. You're basically renting insurance for a period of time during which you're, almost certainly not going to die. That's why it's so cheap. Whereas, whole life insurance, the reason the premium is so high is because the company is reserving for the fact that they absolutely will be paying you that death benefit when you die, not if you die. So you can think of those dollars more as a reserve that you have access to along the way. And I bring that up because, it all stems from the tax-free nature of the death benefit. Because that death benefit eventually will be paid tax-free, even if it's tens of millions of dollars in death benefit. Um, all that internal buildup of cash and your contributions, essentially, like I said, leave the tax system. But without those limitations you mentioned around 401ks or traditional qualified plans, because that's really tax deferral. You might get a deduction up front to get the money in, but when it comes out, it's fully taxable, and actually is a terrible place to create a legacy for the next generation because of that heavy taxation on the backside. So that's what we see a lot of folks doing is when we think about diversification, that term usually revolves around asset classes, stocks, bonds, real estate, business interest, things like that. This is more about asset location, where we're talking about the tax treatment of your assets, so that regardless of what some future president or administration or Congress decides to vote on for taxation, you have an asset that is not taxed historically and is currently protected against income taxes if you don't screw it up. So we have people that have seven-figure cash values in these policies that are using it as a way to hedge against taxation, but while also still getting a pretty reasonable rate of return, like you might expect in bonds.
Now, this is not only income taxation that a 401k is susceptible to, for example, but I'm assuming that this is also avoiding estate taxes. So, if you have, I mean, 401k would avoid estate taxes too. But if you have money outside of that, that's all subject to estate taxes. Now, the exception right now, or the amount that doesn't get taxed is very large, but that has always been a point of contention with Congress, and has changed, fluctuated over the years. There's some years that there was zero, it was 100% exemption, and there was some years that it was very minimal. So you're kind of at the whim of whatever the current political climate is, the time that you pass.
Right. Yeah, absolutely.
So if somebody puts money into these policies and it builds up a cash value, do they have access to that? So if we're looking at this as far as comparing it to a retirement vehicle, at least a 401k, I could draw it down when I'm in retirement. So I want to stop working. I want to be able to live off of that. Am I living off of my whole life policy?
You absolutely can. There's a lot of people that sell it that way or position it that way. I find in reality, most people use it more as an opportunity fund, if you will. So when markets are crashing, or if you want to just yank out 100 grand to go invest in something or take the family on a vacation, I find that's how it's used more often. But yes, I mean that's one of the great things is it's tax advantage, meaning it's tax deferred. So as you put money in, it's going to grow without taxation. But there's a couple nuances that are different from most things you invest in. Although I'm careful to call it an investment. It's an insurance policy, which is why it gets the tax advantages. The first one is FIFO accounting. You actually get your contributions back first before you have to pay taxes on gains. That's actually relatively unique in the investment world. You're typically going to be paying taxes on gains first before getting that money back. The other one, though, is the policy loan feature, which sounds bad, like you're borrowing against your own money. But that policy loan feature allows you to take unlimited gains out of these plans and not owe the IRS a dime in taxes, because loans are not treated as a taxable event as long as it's a bona fide interest-bearing loan, which they are. The rate at which you pay that loan interest tends to be very similar to the rate at which the policy is growing. So it's a bit of a wash, when you kind of understand how these things work. So to answer your question, yeah, we see people taking, 3, 4, 5 times what they've contributed into these plans, done well in retirement if they wanted to. And why it remains income tax free is those policy loans, while technically it's a loan, they get paid off with the eventual death benefit that pays out, when you eventually die. So that tax-free benefit pays off those loans. The remainder goes to your family, and you can hypothetically get back many times what you've paid in, not hypothetically, in reality, without paying the IRS any taxes on it. So it's almost like an unlimited Roth IRA, if you will, if you can fund a plan like this, which again, because of the tax treatment, becomes increasingly attractive to people in very high tax brackets. And that's just for personal use.
Yeah, now let's talk about, because I was just gonna pivot to looking at it as a business owner. Um, Obviously, having access to be able to borrow funds. Let's say you want to do a TV campaign, you need a few $100,000 to make that happen. Having having this at your disposal, where you could just borrow that against your policy, sounds like a dream come true. But uh, I'm curious, is there a way for the premiums that you're paying to be a business expense and get tax advantages up front with that policy? How can we structure it that way?
So typically not. Typically that's one thing that business owners don't like is it's typically not going to be a deductible expense. Sometimes it's deductible incidentally. For instance, if you have a policy that's on, say a set of key executives, oftentimes small business owners will have a key person who's, the secret to their success, has all the relationships in town, couldn't possibly lose this person, so they'll set up a bonus program. And they'll actually use life insurance as a way to fund it. A, because it's guaranteed and has the ancillary life insurance benefits, but also because the early cash values in these plans tend to be relatively low to what you've paid in. It almost has a built-in vesting schedule, if you will, where they don't really start to see big increases in their values for a few years. And that's a deduction incidentally, because it's a bonus to the executive. But
Now, are
typically
they,
not
this
a
is just
deduction.
a quick nuanced question there. So if I'm using it in that way, is the value of those premiums now going on their W-2 as income? Like, are they showing that as income?
If it's a deduction to the business, then typically yes, it's going to show up on the W-2 of the executive or that key person. Now, that said, there are, and if this is probably beyond the scope of this podcast, but there are some strategies for some of the top advisors that I work with who focus on split funded pension designs, where using life insurance, they're actually able to stuff hundreds of thousands of dollars into these plans with a tax deduction up front, and that plan would actually own life insurance on the life of those key executives. So there are creative ways where you can use these designs to get big tax deductions far beyond the traditional 401(k) route.
Yeah, no, that is very interesting, and I don't think it goes beyond our podcast because, we've got firm owners who are earning, millions of dollars, and
Mhm.
these are things that are important. Like we're trying to figure out how do we lower that tax bill and save for retirement, save for the future, build that wealth. And the defined benefit plan is definitely one of the vehicles that you can use to do that, and being able to marry that with this, with the life insurance policy makes a lot of sense. Um, if the life insurance policy is owned by the defined benefit plan, do we lose the ability to borrow against it? Does it have an effect there?
While it's in the plan, you do. So typically, the design that we'll see is the plan will own life insurance as an asset, and typically death benefits will be assigned to either the business or the individual separately through kind of a split dollar arrangement. So while the employee or owner of the business is operating the business, it is tied up until 59 and a half, just like another qualified plan. But usually what we find is that at the end of the day, there's a rollout where the wealthy individual will either buy the asset out of the plan, essentially a swap the asset with their own liquid investments, and then take that policy into their own personal planning world, or through a series of transactions, roll that into a trust to do it advanced estate planning. So at the end of the day, the policy does become individually owned in most cases by being rolled out to those executives. But during the working years, because of the nature of that in the plan and some of the IRS rules, which frankly are a little bit beyond me, it allows for big tax deductions during those working years, and that's what's so attractive about it to these folks that are just printing money in their businesses and finding ways to not pay the not pay the IRS maximum dollars on it.
No, what's interesting is that like so many people are in the camp of being a good candidate for this, but they don't know enough. Like they don't have an advisor that has the advanced strategies. Like where does somebody find the right person to guide them so that they end up meeting somebody like you? Or I don't even know if you sell your own policies anymore, if you're just advising advisors at this point. But I feel like there's very few. I mean, most people are looking at their accountants first. There's very few accountants who understand that what's available to them as far as tax strategies when it comes to this. And then, financial advisors. There's even fewer financial advisors who are pushing people into these life insurance products.
Yeah, 100%. I think it's almost impossible for anyone to know how qualified their financial advisor really is, because they all have the same website and they all have the scrubbed compliance approved language and they all say they can do it all. But in reality, there's probably less than 1% of advisors that really understand some of these very advanced strategies. I've been fortunate because in my travels to know a lot of these top folks. I actually don't sell myself, so I like to hold myself out as an objective third party that has no financial interest in transactions. Anyone listening to this podcast is absolutely welcome to reach out to me if they think that they may have opportunities, and I can lead you to some of the very top people in the space. Forbes puts out a list of top financial advisors each year, and usually advisors will promote that on their website, and that's a pretty good feel for if this person's operating at a high level in a major market. Um, but that would be a way that you could look independently. But I think at the end of the day, it's hard for people to find, but I would want a financial advisor that is affiliated with some kind of insurance company. I find that advisors kind of fall into two camps. There's the money managers, they do IRA rollovers, they'll build an investment portfolio for you, and that's about it. That's what they do. They all call themselves the same thing, but they're really just managing money. And then there's the ones that actually do the more advanced work and have tough conversations around life insurance and unsexy things like that don't sound very good, but at the end of the day, probably provide a lot more value and wealth transfer capability over the years versus just managing an investment portfolio.
Okay, so let's pull it back because I want to get back to the basics. So for those really wealthy listeners, we went on a little detour for you, but for the rest of the folks who, they're in the early stages of their business, or they haven't really figured out how to grow beyond themselves. They're throwing off a couple $100,000 a year in income. They've got their eyes set on getting to the million plus take home pay level. Let's just talk about um, choices. So 401k or whole life, if I need to choose between the two, your position is whole life, correct?
No, I never talk about it in either or. Whole life insurance, is a very conservative vehicle. It's guaranteed to go up in value every single year. Historically, you're going to get, corporate bond like returns. So it's very predictable in that way, where over time you'll get 4 to 6% on your money, riskless and taxless, and there'll be a death benefit. Whereas the 401k is designed to truly invest in a whole variety of things, and the market has averaged, well over 10% historically. So I think the issue is, and this is kind of the crux of my book, just for anyone, whether they're a business owner or not, is you can save however many millions you want to save, but when you get to retirement, if all you have is risk assets, like which is equities, bonds, real estate, all this stuff, if that's all you have, you will be afraid to spend because you've now earned your last dollar on this planet, hypothetically, and you've got to make this sum of money last as long as you do. And with all kinds of variables and risks in place, you're going to be terrified to spend. There's been study after study showing that, retirees are under enjoying their retirement right now and hoarding wealth because there is no defined benefit. There is no pension. They essentially now have to become money managers for the remainder of their time. So yeah, for me, life insurance is more a backstop, and I'll just talk personally. I know that my kids are both going to receive large sums of money upon my death, and my future spouse will receive large sums of money upon my death. And I know that there's a cash value associated with this plan that's not subject to market risk in the 6 or 7 figures that I'll have in my retirement portfolio. So by having that asset there and knowing it's there and knowing it's the backstop, I can actually stay invested in the market right up until the day I retire without being afraid of a market crash. I have that volatility buffer in the portfolio, if you will. And I can annuitize my assets. I can turn my assets into a pension by buying an annuity that will pay out as long as I live, even if that's 60 more years into retirement. Because I know that, even though those assets have been spent, if you will, the legacy concerns and that the insurance portion of the portfolio is taken care of. So that's the mindset really is it can be used for retirement income and it will be, but it's more of a strategic asset that you use, in times when your other assets aren't performing or maybe suffering volatility or high taxation.
Now, you said that you can annuitize your income. Now, I know that somebody can certainly go out into the insurance marketplace and get themselves an annuity going into retirement so that they have that, almost like pension-like feeling, knowing they've got this check coming every single month. Um, how does that work in a whole life policy? And it is because I mean, until now we talked about it growing, it being, tax advantaged, you have it, knowing that you're guaranteed this policy amount, um, be, uh, because you're either going to save and invest to that level, or you're going to die and collect it, right? Um, how does that work when we go into retirement? How, as far as drawing income from the policy?
It's a great question. So I'm going to answer it a little bit differently. So when you go to there's something called the annuity puzzle that the academics in the retirement income planning space have coined. And the annuity puzzle refers to the fact that why isn't everybody annuitizing their assets? The academics all agree it is such a good deal. For an example, if you're a 65-year-old male today and you show up with $1 million to an insurance company, they will give you $75,000 on day one that will be paid out for the remainder of your time that you're alive. So you get all your money back in like 13 years and you start to, and it keeps going and you start to get a pretty reasonable rate of return on your money versus the traditional 4% rule, asset management strategy where you take 3 or 4% of your dollars in year one, half of that annuitized income, and then maybe inflate it over time. It ends up being 20, 25 years before you actually do better than the annuity. It's such a good deal. So the reason so why I bring this up is the two reasons that people aren't really annuitizing their assets. They're not just writing $1 million check to an insurance company for that is they lose two things. If they live a little while, they lose a legacy. That $1 million is not going to pass to the next generation. It's good income stream, but the next generation gets nothing. And the second one is they lose liquidity. They've essentially now tied that money up into an income stream as opposed to an asset they can touch. They probably wouldn't want to anyway because you're invading principal, but they can't. So that's where life insurance fits is if you can guarantee a legacy and you can guarantee a pot of money that you do have liquid access to along the way, then now you have permission to annuitize. Now you have the ability to, trade that, volatile bucket of money into an income stream that you can't outlive. So it's not so much that the life insurance policy is providing the income, although it could. There are ways, as we talked about before, there's ways to get the money out of the life insurance policy to a very large degree. It's more about it now enables us to spend more aggressively, invest more aggressively, or you know trade those assets in for an income stream that life insurance companies uniquely and perfectly can do.
So I just want to make sure I understand. So it now allows us to take that $1 million I have in the bank, turn it into an annuity because I'm not worried about liquidity because I've got the the money that's in this policy to lean on if I need to. In what way? By taking a loan?
Yeah, yeah,
Okay.
exactly.
All right.
That's the mindset. It's not so much more money or this is better than that. It's the concert of the two strategies working together that just provides a lot more options and flexibility.
Yeah, it's almost like people ask me like, what's should I do an IRA or a traditional IRA or a Roth IRA, like, or and or a traditional 401k or a Roth 401k. And the answer is it's not. The mathematical equation is really the same, assuming that your tax bracket's going to be the same at both positions, right? Because it's multiplication and division. It never changes. So it doesn't matter if you pay the taxes now, pay the taxes later. But the difference is how you're withdrawing that money, right? And in a regular IRA or 401k, you have required minimum distributions. In a Roth, you don't. And the same thing with the life policy, right? Like you don't have to, draw any of that money. So when you're assembling this portfolio of this strategy or this plan for preparing for the future, it makes sense to have different baskets where that money is going so that you're not tied to any one requirement when it comes to retirement. You don't want to lose the liquidity. You want to make sure that you also are putting money into that 401k, but you also want to have that mix between the 401k and the Roth 401k or the IRA and the Roth IRA so that you're not required to pull out a certain amount of money every single year, forcing your hand from a tax advantage position in retirement. And then adding whole life to this is just another piece of the puzzle that and I think it's like a thing that's gonna just allow you to sleep better at night. It's kind of like people question, right? Should I pay off my mortgage on my house? And it's not a financial question. It's an emotional question. right? Because
Right.
financially, everyone would say, yeah, you're better off carrying the mortgage, take that money and invest in something, do something with it, right? So, because mortgages are so cheap, but even though they're 6% now instead of 3%, they're still cheap compared to any other access to capital you might be able to get. So the
Yeah.
mathematicians are going to say no, you should carry a mortgage, but the reality is that there, it feels different when you're stepping foot on your house and you don't have a mortgage on it. So this is the same kind of thing. It's peace of mind. It allows you to enter into retirement knowing that not only are you protected, not only are you taken care of, but you've also prepared for the next generation. And I think generational wealth is it's really important, right? People, they're worried about their kids. Many of them, not everybody. Some people could care less, but most people, want something for their children, their grandchildren, and this allows you to make sure that that legacy is there.
Hmm. Yeah, that's exactly right.
Tom, as we head into the home stretch here, what questions haven't I asked that listeners might be asking in their minds? Common things that come up that we just didn't cover. Is there anything that any big glaring ones that we should make sure we talk about before we end our session today?
I mean, a couple things, and we are talking about insurance, and I never like to lead with insurance is just a tool to solve a problem. So I think what people are typically dealing with is they're trying to manage risk, they're trying to balance risk, have risk exposure so they have upside potential, but still have conservative assets that they can tap into during the inevitable, volatile markets. The other big one is taxes. We have to manage tax risk. And I think the third one that I think is a risk that no one thinks about is access risk. You can tie up all your money into a 401k, Roth IRA, all this stuff, but now you're going to be penalized if the money comes out. And if you are a forward-thinking person that, might want to take advantage of an opportunity to invest in a business or a property or things like that along the way, having all of your capital tied up in these qualified plans can be very limiting. It has been to me in a couple opportunities along the way. So I think of it in that way. I call it the art of life insurance planning is, you're basically diversifying your access. You're diversifying your risk because you're getting basically bond-like returns with none of the volatility. And you're diversifying your tax treatment so that you have choices along the way. But not necessarily in an ERISA, a retirement account that has a lot of those strings attached, income limitations, et cetera. So it's truly, non-qualified planning. And if there's a catch, the only catch is that you're not going to get stock market returns. You are going to get bond-like returns, 4, 5, 6% predictably over time. But that's good. Every person, every prudent investment portfolio should have that allocation. I call it the boring allocation. But whole life insurance, for all the reasons we talked about today, I think is the best boring money can buy right now.
Now I'm going to ask this question because I mean, there's people been on the podcast before, or there's other, other podcasts out there that talk about this strategy where, investing in real estate is touted as one of these strategies where it's, building that generational wealth because of the stepped up basis that you can provide to your heirs, upon your death, leave them a bunch of real estate, and now goes to the value of it, the basis of it goes to the value upon death. So, there's no taxes on that. Another way to avoid taxes in your wealth creation strategy. I'm sure this question comes up. How does somebody navigate that question of, should I invest in, a real estate portfolio versus putting money into a whole life policy? Is that even something that people are looking at and saying either or on that?
They're thinking either or, but they shouldn't be. That's an and too. Actually, I find that the savvy real estate market actually uses life insurance as an alternate to other sources of capital. So the traditional method is you save up money in a savings account, and then as soon as you have enough money for a down payment, you go buy a property with it. Well, you can do the same thing inside of whole life insurance with some amazing tax advantages and have death benefit protection along the way. So we see people that actually overfund these policies and make them very attractive in terms of cash value growth early on. And because it's accessible at any time through policy loans, you can build up the cash value in a policy, take a policy loan, buy real estate. I've done that 3 times in my life. I use mine almost like a piggy bank. I'm constantly putting money in and out of it as it grows. So I think for real estate folks, it's great. Once you take that policy loan, it actually creates a vacuum of potentially hundreds of thousands of dollars that you can then pay into and drop large lump sums at any time and then continue and then have that money continue growing without taxation. So it actually becomes one of the greatest strategic assets for real estate investors versus just the traditional savings account, which, pays very little and you're taxed on that little. Um, but to answer that question too is I think a lot of folks, get a little over their skis sometimes in real estate where they do have profitability and they're always pouring any profitability into the next deal. And during a real estate crash, that can kind of leave you hanging out to dry if you don't have that liquidity in the portfolio. So it becomes a liquidity management tool. And then finally, the death benefit. I have found, when we come across people that have real, big wealth, obviously there's the business owners, but the other crowd are the people that have built big real estate portfolios. And upon death, if you have estate tax issues, then, the IRS wants their money immediately after death. And you got to start selling properties potentially at fire sale losses to raise capital to pay the IRS. So having those permanent death benefits in your plan provides cash liquidity to pay those estate taxes and keep your real estate empire intact. So it's a big question that can be answered in a lot of different ways.
Yeah, no, I really appreciate the context and the color. And I honestly, I didn't even think about just using it instead of putting money into a savings account. I think the thing that might hang people up with doing that is when I open the policy, I'm making the commitment to this ongoing premium payment that I'm putting into it. So, what if I'm in the position, today to be able to save at that rate, but then down the road I'm not? What kind of risk does that put myself, my policy at? To be able to manage that. And then the other side of it is, today it might make sense for me to take $1 million policy, but as it grows, am I just adding additional policies, or am I able to adjust the death benefit upwards because now I could fund more money into it?
Yeah, there's a number of different ways to design it. So like right out of the box, yeah, you're signing up for a premium payment that has to be paid every single year. That said, when we come across folks that may have concerns about the ability to do that on an ongoing basis, they can be built in a way with a lot of downward flexibility on premium payments. For it to work long term, the money's got to get in there eventually over time. But usually, if you can just commit to it to 2 or 3 years, there's a lot of flexibility thereafter of how those contributions get made. In terms of increase, there's really two catches to this that I find. There's two, there's two hurdles you have to get over. The first is you have to be healthy enough to own it. That's kind of understood. It's medically underwritten, so you don't have to be a marathon runner, but you got to be probably average health or better for the economics to look really good. And the second one is patience. They tend to have, relatively low values in the first couple of years, and that's because the insurance company is recouping all their costs of actuaries and attorneys and marketing departments and all that goes into running a life insurance company. But usually by year 3 or 4, every dollar you pay in is yours plus interest and growing. So when that kind of covers, the patience hurdle, but you never get away from that medical requirement. So if your wealth explodes and that 1 million now needs to be 10 million, that will require underwriting, but you can increase the plan along the way, depending on the company that you're with and how you want to do it. I know lots of wealthy folks that own a dozen policies though, as they've kind of added on to their plan over time.
And one last question, and we'll bring it home um and close the show out. You mentioned people overpaying into their policy or stuffing their policy. How does that work, and where does that money go? Is it removing future payments that you're required to make, or how exactly does that work?
Yeah, it's complicated. I think that's the other hurdle is people have to. It's unlike any other vehicle out there. So, the IRS has something called the MEC threshold or the 7-pay test on life insurance, and it came into play in the early 1980s because people were using this as a tax dodge. They were putting, $1 million into a $1.1 million life insurance policy, which at that point basically isn't insurance anymore. It's now just a tax advantage savings account. So they make you spread it out a little bit. Um, and and you can overfund these plans. When I say that, there's something called a paid-up addition. So not to get too complicated with it, but basically a paid-up addition is essentially a reinvested dividend from these policies. The ones I'm talking about are dividend paying life insurance policies from the biggest mutual life insurance companies out there that date back to the 1800s. So what a paid-up addition is essentially a little paid-up piece of life insurance where if you put in $10,000 today, it would buy you just making a number up, $25,000 of life insurance that would last as long as you do. Um, but your cash value is 100%. So you put in that 10,000, you've got 10,000, or maybe there's some charge against that. So when you fund it and when that, like, it does increase your insurance, but you're essentially adding liquidity up front, via those cash values. So it's not technically a prepayment of the policy. It's additional funds on top of the policy that can be used to pay those future premiums or provide flexibility. Um, a lot of complexity with the design, so it's important to be working with the right advisors that understand this stuff. But but we see people getting very creative with this and using it as an alternative to the other, traditional safe places for capital, while protecting, business interests and their families.
Absolutely. I love this conversation and the insight. I mean, there's so much to this, and it doesn't seem that way, right? Like we've all gotten a call from a friend or a buddy or somebody who's become a life insurance agent, and they're trying to sell you a whole life policy, and you're trying to wrap your head about whether it's worth it. But this kind of conversation is not the one that's happening around your kitchen table. So really glad that you came on the show here, Tom, to share with us. And folks, make sure to check out Tom's book, Permission to Spend. I'm going to check it out myself. Excited to dive into that and really wrap my head around this topic, because I'm in the unique position of advising people. I'm not a financial advisor, but just giving people ideas of what they should be thinking about, and perhaps who they should be putting into their corner, to be going to bat for them in the journey of their wealth creation. So really insightful stuff. Tom, when I wrap up the show, I wrap up with two things. Number one, what is it, one parting piece of advice or wisdom you want to leave with our audience? Number two, if somebody wants to get in touch with you, learn more about you, or if there's somewhere you want to send them, from this conversation, where would that be?
I would say the piece of wisdom, and I kind of went into it a lot today, is that it's never either or, it's always and. I think a lot of people try when they think about saving and investing and retirement plan, all this stuff is they think there's one right answer. And if there was, there wouldn't be a profession around the space. Every situation's different. So think broader in terms of how assets interact, not this asset versus the other one. And then I would say follow me on LinkedIn. I think that's a great place to connect. I'm pretty easy to find. Tom Wall on LinkedIn. Permission to Spend is the book, or permissiontospend.com. If you happen to work with financial advisors and any of those strategies sounded interesting, then by all means, send me a direct message on LinkedIn. I can connect you truly with the best in the business that do business at the very highest levels, all the way up to billionaire families. So if you are working with that kind of crowd, and you're looking for that kind of partner, you're talking to a guy who knows thousands across the country and can make those connections.
Awesome. Thank you so much, Tom. Folks, we will link all that up in the show notes for this episode, which you can find in the description of your podcast player, as well as at profitwithlaw.com. If you're watching this on YouTube, we appreciate you being here. Hit that subscribe button so you get notified every time a new video gets released. If you're listening on a podcast player, same thing for you. But go check out the other channel. So we not only produce podcast episodes on YouTube, but we also have specific content that is put out there that is not here on the show in an audio format on the podcast players. So you definitely want to go to profitwithlaw.com/YouTube, hit subscribe so that you get notified when new videos are dropped. And once again, if you're looking to massively increase your wealth, create that generational wealth, you want to get set on the right path for doing that. You want to unlock massive profitability in your business. You want to grow your business exponentially. Then you definitely want to have a strategy session with us at profitwithlaw.com/strategy session. 30-minute conversation can absolutely change your life, and it absolutely costs you nothing. So check it out, profitwithlaw.com/strategy session. Tom, thank you for being here. We are here every Thursday. We'll see you next week with another amazing guest interview. Take care, folks.